When recessions hit, most investors panic. Markets fall, portfolios shrink, and headlines scream crisis. But here's the truth. Money doesn't disappear. It moves. It flows from risk to safety, from speculation to survival. And for the past 2 decades, one sector has quietly proven itself as the ultimate shield: consumer staples, ticker XLP. 1. The nature of defensive investing. When the economy slows, people stop buying new cars, gadgets, or luxury goods. But they don't stop buying food, soap, toothpaste, and toilet paper. That's what makes consumer staples so powerful. They sell what people need, not what people want. And in a world driven by debt, uncertainty, and volatility, need is the most stable business model you can find. 2. The 20-year proof. Look at this chart. This is XLP, the Consumer Staples ETF, tracking giants like Procter & Gamble, Coca-Cola, PepsiCo, Walmart, and Costco. Over 20 years through multiple recessions, from the dot-com crash to 2008, from COVID to inflation, this chart has moved in one direction, up and to the right. Even in 2008, while the S&P 500 dropped nearly 50%, XLP fell only 28% and recovered within 18 months. During the COVID crash of 2020, it bounced back faster than tech. Because people may stop trading stocks, but they'll never stop brushing their teeth or buying groceries. 3. Why XLP works. There are 3 reasons why XLP is the anchor of every long-term portfolio. First, stable demand. Revenue barely drops even in recession because these are daily essentials. Second, strong pricing power. Companies like Coca-Cola and P&G can raise prices without losing customers. Third, reliable dividends. These firms have been paying and increasing dividends for decades. That's real cash flow, not speculation. 4. The psychology of safety. Recessions don't just destroy wealth, they destroy confidence. When people are scared, they don't want growth stories. They want security. And the market rewards that mindset. That's why XLP often outperforms during market downturns. It's not exciting. It doesn't go viral, but it protects, and protection is what keeps you in the game long enough to win. 5. The strategy. Here's how smart investors play defense. When everything looks euphoric, reduce exposure to high-risk growth stocks. When volatility rises, increase allocation to defensive sectors like XLP, healthcare, and utilities. You don't stop investing, you rotate. And when the storm passes, you already have dry powder ready to buy growth again. 6. The lesson from XLP. Over the last 20 years, XLP compounded wealth quietly, without hype, without risk, without collapse. It's not a get-rich play. It's a stay-rich play. In a world chasing the next big thing, sometimes the smartest move is sticking to the simplest truth. People will always need the basics. Conclusion. When the next recession comes, don't ask, "How can I make money fast?" Ask, "How can I protect what I've built?" Because wealth isn't about timing the top, it's about surviving the bottom. And history shows, those who held XLP didn't just survive, they thrived. Stay patient, stay disciplined, stay consistent. This is JP Finance,